Artificial intelligence has already rewritten the rules of finance, from automated trading to credit scoring, fraud detection, and portfolio management. But as markets move deeper into the age of machine-driven decision-making, a new and far more dangerous question is emerging. Could AI itself trigger the next global financial collapse? History shows us that every major technological leap in finance, from the telegraph to high-frequency trading, has introduced new risks alongside new efficiencies. The danger today is not that AI will simply make mistakes, but that millions of interconnected algorithms could make the same mistake simultaneously, at a speed no human can detect or stop in time. This video explores how such an event could unfold, using real-world data, historical precedents, and current trends to paint a factual, researched picture of the world's first AI-driven financial crash. To understand the scale of the risk, consider how deeply AI has already penetrated global markets. Algorithmic and high-frequency trading account for an estimated 60%–70% of equity trading volume in the United States, according to various market structure studies published over the past decade. In foreign exchange markets, automated trading now makes up more than half of all volume. Major banks rely on machine learning to evaluate creditworthiness, detect anomalies, predict market trends, allocate assets, and even interpret economic data. Hedge funds employ reinforcement learning systems that adjust strategies every millisecond, far beyond any human ability to supervise. These systems are powerful, precise, and extraordinarily fast, but they are also opaque, unpredictable, and capable of interacting in ways their creators never intended. In finance, speed is both an asset and a weapon, and AI has pushed speed into a zone where markets can break faster than they can be stabilized. A clear historical warning came in May 2010 during the flash crash, when the Dow Jones Industrial Average plunged nearly 1,000 points, about 9% in minutes, before recovering almost immediately. Regulators later concluded that a combination of algorithmic trading, high-frequency strategies, and feedback loops caused liquidity to evaporate almost instantly. This event was not caused by modern machine learning systems, but it revealed something crucial. When automated systems interact without guardrails, they can create sudden, violent contagion. The flash crash involved algorithms that were far simpler than today's predictive models, yet still produced one of the most dramatic intraday anomalies in history. Now imagine the same scenario with deep learning systems capable of autonomous strategy changes, recursive optimization, and real-time adaptation systems that can react far faster than humans and far faster than regulators can intervene. One of the most dangerous emerging risks is algorithmic herding, a phenomenon where many AI systems, trained on similar data sets and economic signals, converge on identical decisions. This is not speculation. Research in financial stability circles has consistently flagged this issue. When thousands of models are trained to maximize short-term predictive accuracy, they often identify the same correlations and execute the same trades. This creates a monoculture in decision-making, reducing diversity in market behavior, which is essential for absorbing shocks. If one AI model interprets a data point as catastrophic and begins selling, dozens of others may detect the same pattern and react in nearly identical ways. This synchronous behavior can trigger liquidity shortages, rapid price cascades, and multi-market contagion. In the past, human traders introduced variation, different opinions, different strategies, different emotions. AI reduces that variation dramatically, and in a system as interconnected as global finance, homogeneity is itself a systemic risk. Another key vulnerability is speed-driven amplification. AI systems react not in seconds or milliseconds, but microseconds. They analyze thousands of data feeds, news, sentiment, economic indicators, volatility signals, and translate that into orders almost instantly. Human regulators and market makers simply cannot match this pace. If an unexpected event occurs, a geopolitical shock, a misreported economic stat, or even an erroneous social media post, AI systems may begin aggressively repricing assets before humans even understand what has happened. We saw a small taste of this in April 2013, when a hacked Associated Press tweet falsely reporting an explosion at the White House briefly erased about $130 billion from U.S. markets. Algorithms scanned the news, assumed catastrophe, and sold automatically. Humans later corrected the error, but the lesson remains powerful. Markets can collapse before anyone has time to verify information. A deeper problem lies in the opacity of machine learning systems. Traditional financial models were transparent. Regulators could analyze assumptions, inputs, and outputs. Modern AI models, especially neural networks, function as black boxes. They make predictions based on patterns that even their creators cannot fully decode. When multiple opaque systems interact, it becomes impossible to predict their collective behavior. During stable times, this may not be an issue, but in moments of stress spikes and inflation, rapid rate changes, geopolitical shocks, these models may behave in ways that are nonlinear, irrational, or self-reinforcing. A model might see a slight increase in volatility and sell to reduce risk. Another model, observing the first model's sell-off, interprets it as a larger signal and sells even more. Within seconds, multiple models amplify each other's reactions, turning a small disturbance into a violent market spiral. There is also the growing risk of AI-driven misinformation influencing markets. Generative AI systems can produce highly realistic fake reports, fraudulent analyst notes, deepfake CEO announcements, and fabricated economic data. If such content spreads even for a few minutes, AI-driven trading systems could react instantly and aggressively. Unlike human traders, algorithms do not pause to consider plausibility. They react to data inputs. A coordinated misinformation campaign, or even an accidental release of false information, could trigger massive automated selling or buying. The infrastructure of global finance was never designed for an environment where deception can be produced at industrial scale and absorbed by trading algorithms in microseconds. The next category of risk is over-reliance on shared AI infrastructure. Many financial institutions depend on the same small group of AI service providers, cloud computing platforms, and data vendors. This concentration means a single software bug, model update, data corruption event, or cloud outage could affect dozens of major firms simultaneously. In previous decades, risk was distributed across different systems and technologies. Today, it is centralized in a few AI pipelines. A malfunction in one widely used model could propagate across entire markets, creating synchronized reactions. This is similar to biological ecosystems. The more uniform the organisms, the more vulnerable the system is to a single pathogen. In finance, uniform AI tools create the possibility of simultaneous failure across multiple institutions. A final and extremely serious risk is autonomous AI interacting with leverage. Leverage borrowed money has been at the center of nearly every major financial crisis. If AI systems begin to adjust leverage levels rapidly, without human intervention, the consequences could be catastrophic. For instance, an AI system might suddenly decide that market risk has increased, causing it to reduce leverage positions across multiple assets at once. This mass deleveraging could trigger margin calls, forced liquidation, and cascading defaults. Many funds use machine learning systems to dynamically adjust leverage based on volatility, correlation, and liquidity. If volatility spikes unexpectedly, these models may all react in the same direction, at the same moment, flooding markets with sell orders. In a highly leveraged environment, this can lead to a crash faster than any coordinated human response. So what would an AI-driven financial crash actually look like in real time? It would not resemble the slow burn crises of the past. Instead, it would be sudden, violent, and largely automated. Markets could experience extreme price movements in seconds. Trading halts would trigger across multiple exchanges. Cross-asset contagion, stocks, bonds, commodities. Crypto would spread instantly because the same models operate across asset classes. Regulators would scramble to understand what happened, but by the time any human analysis begins, trillions in value could evaporate. Only after the fact would investigators attempt to reconstruct the chain of algorithmic decisions that caused the collapse, discovering that no single system intended to trigger a crash but together, their interactions created a self-reinforcing downward spiral. The solution is not to abandon AI in finance, because its advantages are undeniable. Instead, the world needs stronger guardrails, mandatory transparency for critical models, real-time supervision systems, circuit breakers designed for microsecond trading, and diversification of AI tools across institutions. Financial stability researchers are increasingly calling for algorithmic stress tests, where regulators simulate extreme scenarios to see how AI models react collectively. There is also a growing push for human-in-the-loop systems that require humans to oversee or approve certain categories of high-impact decisions. The goal is not to slow innovation, but to ensure that the incredible speed and power of AI does not outpace our ability to control it. If you enjoyed this deep dive into the risks shaping the future of the global economy, make sure to like the video, subscribe to Retro Finance Files, and share this with someone who follows financial history. Your support helps us continue producing high-quality, well-researched content that uncovers the hidden forces behind markets, money, and power. Thank you for watching, and I'll see you in the next episode.